Well, there's not a lot of fiscal wriggle room out there, but that hasn't stopped the government making a few changes in Budget 2025 out today. Now, the real anchor point for the fiscal strategy is forecasting a return to surplus at the end of the government's forecasting period. We've seen quite a lot of reshuffling of spending priorities today, but through all those overs and unders, we've still got that forecast return to surplus out in the year to June 2029, albeit it's now wafer thin. Now, we still think getting there is going to be difficult. It does rely on a lot of things going right. And as expected, we saw the Treasury today just nudge down its growth forecast marginally to take into account the volatility we're seeing offshore at the moment. But it does mean there hasn't been much of a lift in the government's projections for its own debt. Now, net core crown debt still peaks at about 46% of GDP out in 2028. That's quite a lot lower than many other countries around the world, so it should keep the rating agencies relatively happy, we think. In terms of what it might mean for the economy and for interest rates, well, of course, there's lots to absorb, but just to highlight 3 points. The first is that we got the much hinted at tax incentive scheme for business investment. I won't go into all the details, but the important bits are that it kicks in immediately and does lean in the direction of supporting business investment activity, an area of the economy that we've been openly wringing our hands about recently. So to the extent it supports business investment, it will add to GDP growth in the next few years, and maybe as well labour productivity growth in the area of the economy that had also been under some pressure recently. The question still is whether the current weak economy and uncertain global environment just sees businesses continue to sit on their hands. Second, we've got some changes to KiwiSaver. The default rate of contributions will be lifted from the current 3% up to 4% over the next few years to 2028. Now, that might have some implications for household spending activity because it is an upfront impost on discretionary incomes, although people can still opt out of those changes if they choose. Now, on interest rates, the news that got a little bit of attention in markets was the fact that the Treasury has lowered its forecast for the bottom of the Reserve Bank's official cash rate cycle to 2.5%. That's seen some small falls in wholesale interest rates today, but we haven't changed our long-held forecast for the Reserve Bank's cash rate cycle to bottom out at 2.75%. The Reserve Bank, of course, meets next week, and we haven't changed our expectations in that regard. We're still expecting another 25-point rate cut next week, and I'll be back with an update then.